Bitcoin just crashed to 78,719, down 6.5% in a single day. As of Saturday, February 1st, the world's largest cryptocurrency is bleeding, and a single decision by one man just wiped billions from the market. This move could affect your portfolio faster than most people realize. Now watch carefully. Something just shifted in Washington, something that explains why crypto is collapsing while gold hits record highs and stocks keep rallying. The entire crypto market is in freefall. Ether down 11.76% to 2,187. Bitcoin at its lowest since November 21st. Billions erased in 48 hours. If you hold crypto, trade crypto, or thought this was supposed to be a golden era, this affects you directly. Here's the uncomfortable truth. This isn't random volatility. This isn't a healthy correction. This is what happens when the force that created the crypto boom is about to reverse. There's one risk most crypto investors haven't priced in. The very liquidity that fueled Bitcoin's rise is about to be systematically drained. And the man who's going to drain it? Kevin Warsh, Trump's pick for the next Federal Reserve chairman. I've studied Fed cycles longer than most Wall Street analysts. I've seen this pattern more than once in my lifetime. When the people who control money decide to tighten, speculative assets don't correct. They collapse. This affects your savings, your portfolio, and your financial future. By the end of this, you'll understand exactly why Bitcoin is crashing, what Warsh's agenda means for crypto, and what happens next. Bookmark this. We'll test these predictions in 90 days. This isn't about politics. This isn't about ideology. This is about incentives. Pure, cold, unavoidable incentives. I've spent decades watching markets, watching what happens when central bank policy shifts, watching how liquidity flows, and what happens when it stops. And I'll tell you something simple. When a new Fed chairman takes over with a stated agenda to shrink the balance sheet and reduce liquidity, you don't ask if speculative assets will suffer. You ask how much and how fast. Here's the answer. 3 data points, 3 pressure points. Each one alone is significant. Together, they create a Lollapalooza, a compounding of forces that explains exactly why crypto is crashing. But the third data point is the one that turns concern into certainty. And the real danger isn't what happened this weekend. It's what happens over the next few months. If you're holding spot Bitcoin, this matters. If you're leveraged, this is dangerous. And this is where the pattern becomes impossible to ignore. Here's the first number, 1/3. That's how much Bitcoin has lost since striking record highs in October last year. From record highs to 78,719, a third of its value gone. Now zoom out. This isn't a correction. This is a trend. Saturday's 6.5% drop came after Friday's plunge to $81,104, the lowest level since November 21st. Ether crashed even harder, down 11.76% to 2,287. The entire crypto market is bleeding. Here's the uncomfortable truth nobody wants to say out loud. This was supposed to be the golden era. Trump was supposed to be crypto-friendly. Regulation was supposed to ease. Institutional flows were supposed to accelerate. None of that is saving crypto right now. Why? Because something more powerful is at work. Liquidity. Or more precisely, the expectation that liquidity is about to disappear. If you're holding spot Bitcoin, this part matters. The Fed's balance sheet currently stands at roughly $7.5 trillion. That's down from a peak of nearly $9 trillion in 2022, but still massively elevated compared to pre-pandemic levels. That excess liquidity has been the hidden fuel for speculative assets. Pause, forget politics. Think like capital. Capital flows toward opportunity and away from risk. When liquidity is abundant, capital tolerates speculation. When liquidity tightens, capital flees to safety. And right now, the incoming Fed chairman is signaling that liquidity is about to get a lot tighter. Here's the short version. Kevin Warsh wants a smaller Fed balance sheet. A smaller balance sheet means less money sloshing around the financial system. Less money sloshing around means less fuel for speculative assets. And crypto, love it or hate it, is the ultimate speculative asset. When incentives align like this, outcomes stop being opinions and become math. But the real shift hasn't started yet. Keep this in mind. It connects to everything that comes next. Now the second data point. And this is where the situation turns serious. Kevin Warsh isn't just another Fed chairman nominee. He's a Fed critic, a reformer, a man who's been calling for regime change at the central bank for over a decade. Now here's the part Wall Street is quietly nervous about. Warsh has called for, among other things, a smaller Fed balance sheet. Let me explain why that matters for crypto. The Fed's balance sheet is essentially a measure of how much money the central bank has pumped into the financial system. During the pandemic, the Fed's balance sheet exploded from $4 trillion to nearly $9 trillion. That's $5 trillion of new money injected into markets. That money had to go somewhere. Some of it went into bonds, some into stocks, some into gold, and a lot of it went into crypto. Brian Jacobson, chief economist at Annex Wealth Management, explained it perfectly. The Fed's bloated balance sheet, combined with heavy-handed bank regulation, had kept liquidity trapped on Wall Street instead of flowing to Main Street. Read that again. Liquidity trapped on Wall Street. That trapped liquidity fueled bubbles in bonds, in crypto, in metals, in meme stocks. Jacobson was blunt about what this created: asset bubbles propped up by artificial liquidity. Now here's where this part decides the next 6 months. Pause here, because this is where most crypto YouTubers are wrong. They'll tell you crypto is crashing because of fear or sentiment or whale manipulation. That's surface level thinking. The real driver is structural. It's the balance sheet, it's liquidity, it's incentives. Now here's the twist. Warsh wants to fix that. He wants to shrink the balance sheet. He wants to redeploy that trapped liquidity to the real economy. That sounds good in theory, but here's the math that matters for crypto investors. If the Fed shrinks its balance sheet, liquidity drains from financial markets. If liquidity drains, speculative assets lose their fuel. If speculative assets lose their fuel, prices fall. And crypto, which has no earnings, no dividends, no cash flows, is entirely dependent on sentiment and liquidity. Take away the liquidity, and what's left? Speculation without fuel. That's exactly what we're seeing right now. If you're leveraged in crypto, this is dangerous. Margin calls are coming, liquidations are accelerating, and the forced selling is just beginning. This is the turning point, and this is where the system starts shifting. Now the third data point, now here's the part most people skip, and that's a mistake. This next dynamic is quiet, but it matters more than Warsh, because it explains why the selling might accelerate. Brian Jacobson said something crucial. Sometimes these price adjustments feed on themselves. Let that satisfactorily sink in. Price adjustments feed on themselves. That's not just commentary, that's a warning. Here's how it works. When Bitcoin drops sharply, like it did Friday and Saturday, it triggers a cascade. Stop losses get hit. Margin calls go out. Leverage positions get liquidated. Forced selling creates more selling, and more selling creates panic. Jacobson added the key insight. Friday's abrupt drop reminded people of the risks. If you're holding spot Bitcoin, this part matters. Think about what that means psychologically. Crypto investors, especially retail investors, have been holding through the decline, hoping for a bounce, hoping Trump would save them, hoping institutional adoption would kick in, hoping the golden era would arrive. Now they're being reminded that this asset class can lose a third of its value in a few months. That reminder changes behavior. It shifts sentiment from buy the dip to get me out. And when enough people shift that way, the selling becomes self-reinforcing. Jacobson was explicit about what comes next. It's possible, if not likely, that we see more selling over the next few days. That's not fear-mongering. That's an economist at a major wealth management firm telling you to prepare for more pain. Here's the uncomfortable truth. Crypto has been struggling for direction since tumbling last year. It's been left behind by big rallies in gold and stocks. Gold is at record highs, above $5,380 an ounce. Stocks have been hitting new peaks, and crypto down a third from its highs, losing ground while everything else gains. That's not a buying opportunity. That's a warning sign. When an asset class underperforms during a broad market rally, that tells you something about its underlying strength, or lack thereof. This is where most people get lost in the complexity. But here's the simple version. Think of liquidity like water in a garden. When water is abundant, everything grows, even the weeds. When water gets cut off, the weakest plants die first. Crypto, in this analogy, is the weed. It grew fast when liquidity was flowing. Now liquidity is being cut, and it's dying first. That's not ideology, that's arithmetic. Now let's connect the dots, because this isn't random. This is a pattern. You have Bitcoin down a third from record highs, a sustained decline, not a correction. You have a new Fed chairman who explicitly wants to shrink the $7.5 trillion balance sheet, the very thing that fueled crypto's rise. You have self-feeding selling dynamics, margin calls, liquidations, and sentiment shifts that could accelerate the decline. Three different forces, three different sources, one direction, down. Relief rallies calm headlines. They don't fix fundamentals. When incentives align like this, markets don't find support. They find new lows. Now let's invert. What would have to happen for crypto to stage a sustained recovery? The Fed would have to reverse course on balance sheet reduction. Liquidity would have to start flowing again. Warsh would have to abandon his reform agenda. Sentiment would have to shift from fear to greed. Does that sound likely to you? I didn't think so. Here's the math that matters. Bitcoin lost 6.5% on Saturday alone. It's down a third from October highs. It's at its lowest level since November 21st. The incoming Fed chair wants to drain the very liquidity that created the crypto boom. When incentives align like this, the outcome stops being a guess and becomes a mathematical inevitability. Crypto may bounce, but until the underlying liquidity picture changes, every bounce is a selling opportunity, not a buying opportunity. By mid-2026, we'll know if this was a bottom, or just a pause before the next leg down. So where does this end? Let me give you the honest assessment. The bull case. Warsh doesn't follow through on balance sheet reduction. The Fed pivots back to easing. Liquidity returns to markets. Crypto finds a bottom and starts recovering. Institutional adoption accelerates. Bitcoin reclaims its highs. The bear case. Warsh follows through on his agenda. The balance sheet shrinks from $7.5 trillion toward $5 trillion or lower. Liquidity drains from financial markets. Crypto continues its decline. The self-feeding selling accelerates. Bitcoin tests new lows, potentially much lower than current levels. The most likely case. Something in between. Volatility, uncertainty, bounces that don't hold, declines that don't crash all at once. A grinding, messy transition as crypto adjusts to a world with less liquidity. Here's the sentence that tells you everything. Brian Jacobson at NX Wealth Management said it directly. It's possible, if not likely, that we see more selling over the next few days. That's not speculation. That's an economist telling you what the math suggests. A weaker liquidity environment doesn't announce itself with a crash. It shows up as a slow bleed, punctuated by sharp drops that remind you of the risks. That's exactly what we're seeing. Now here's the uncomfortable truth. This was supposed to be the golden era. Trump was supposed to be crypto-friendly. Regulation was supposed to ease. The winds were supposed to be at crypto's back. And yet, as of Saturday, February 1st, Bitcoin has lost a third of its value. Ether is down almost 12% in a single day. The entire asset class is underperforming gold and stocks. The golden era isn't arriving. It's being priced out. This isn't noise. This isn't politics. This is a structural shift. Money is losing its artificial support, and crypto is feeling it first. The Fed's $7.5 trillion balance sheet has been crypto's hidden tailwind for years. That tailwind is about to become a headwind. And by the time most people realize what's happening, the adjustment will already be underway. So what do you do with this information? Three things: cold, logical, no emotion. First, understand what's actually driving this. This isn't about Trump. This isn't about regulation. This is about liquidity. The Fed's $7.5 trillion balance sheet fueled crypto's rise. Warsh wants to shrink that balance sheet. Less liquidity means less fuel for speculation. That's the fundamental dynamic you need to understand. Second, watch for self-feeding selling. Jacobson warned that price adjustments can feed on themselves. Margin calls trigger liquidations. Liquidations trigger more selling. More selling triggers panic. If you're holding leverage positions, be extremely careful. This is not an environment for aggressive risk-taking. Third, recognize what the relative performance is telling you. Gold is at record highs above 5,280. Stocks have been rallying. Crypto is down a third from its highs. When one asset class underperforms while others surge, that's a signal. It means capital is rotating away from crypto, not into it. Fourth, prepare for more volatility, not stability. Jacobson said more selling is possible, if not likely, over the next few days. That's not fear-mongering. That's realistic assessment. If your portfolio is heavily concentrated in crypto, you're making a bet that the liquidity dynamics reverse. That's not a plan. That's a gamble. Fifth, think about liquidity, not just price. The price of Bitcoin can stabilize at 75,000 or 70,000 or lower. But if the Fed keeps draining liquidity, the structural headwind remains. Price stability doesn't mean the danger is over. It might just mean the next leg down hasn't started yet. None of this is advice. All of this is arithmetic. I've spent my whole career trying to understand incentives. And right now, the incentives are clear. The Fed wants to shrink its $7.5 trillion balance sheet. Warsh wants regime change. Liquidity is being drained. And crypto, which depends entirely on liquidity and sentiment, is the first casualty. When the people who control money decide to tighten, everything downstream must adjust. This isn't about morality. It's about simple arithmetic. Subscribe if you want to think like capital, not like victims. I'll keep following the numbers so you don't have to guess. The dollar just hit a 4-year low, and if you hold cash, this could quietly destroy your purchasing power. Let that satisfactorily sink in, because most people won't understand what this means until it's too late. The world's reserve currency, the backbone of global trade, the asset every central bank holds as their ultimate safety net, down over 1% in a single day, lowest level since 2021. And when the president was asked if the dollar had fallen too much, he said the value of the dollar is great. Pause for a second. This part matters more than people realize. The man who controls American trade policy just told you he's fine with your dollars buying less. Now watch carefully. This isn't just a currency move. This is a signal. Gold just hit a record above 5,380. Oil surged to a 4-month high. The euro broke 120 for the first time in 4 years. The Australian dollar spiked to a 3-year high. And here's the part that should keep you up at night. While all this is happening, the Federal Reserve is walking into a rate decision under criminal investigation of its own chairman. A sitting Fed governor faces removal. A successor is being nominated in weeks. This is where people get blindsided. When the world's most powerful currency falls this fast, while the central bank is under political siege, and the administration shows no urgency to stop it, that's not volatility. That's not noise. That's a regime change in motion. This mirrors what happened before the 1970s dollar crisis, when confidence cracked and the entire monetary system had to be rebuilt. By the end of this, you'll understand exactly why this outcome was predictable and what happens to everyone who ignores the signals. This isn't about politics. This isn't about ideology. This is about incentives, pure, cold, unavoidable incentives. I've spent decades watching currencies, watching capital flow, watching what happens when the people who control money face pressure they can't escape. And I'll tell you something simple. When you see the dollar falling, gold surging, and the central bank under siege, all at the same time, you don't ask if something is wrong. You ask what's breaking. Here's the answer. 3 data points, 3 pressure points. Each one alone is significant. Together they create a Lollapalooza, a compounding of forces that makes the outcome almost mathematically certain. But the third data point is the one that turns concern into certainty. And this is where the pattern becomes impossible to ignore. Here's the first number, 96.27. That's where the dollar index sits right now, the lowest in 4 years, down over 1% in a single session, the sharpest sell-off since Trump's tariff blitz rocked markets last April. Now here's why this matters to you personally. The dollar index measures the U.S. currency against 6 major rivals: euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. When this index falls, it means the dollar is weakening against all of them simultaneously. Think about what that means for your daily life. Everything America imports, electronics, cars, clothing, food ingredients, gets more expensive. Your dollars buy less, even if your paycheck stays the same. And here's the part nobody is paying attention to. This isn't happening in a vacuum. Jan von Gerich, Nordea's chief markets analyst, explained it clearly. Last week, when there seemed to be a flight from the U.S. in general, you had equities falling, treasuries taking hits, and the dollar falling. Now it's more of a dollar story. Pause for a second. This part matters more than people realize. Last week, everything American was getting sold. Stocks, bonds, currency, all of it. That's not normal profit-taking, that's capital flight. This is like the foundation of a skyscraper starting to crack. You don't see it from the street, but the engineers are panicking. Now it's concentrated on the dollar. And this is where it gets worse. When asked whether the dollar had declined too much, Trump said the value of the dollar was great. Guy Miller, chief market strategist at Zurich Insurance Group, translated what that really means. Despite the falls in the dollar over the past 12 months, it was coming from a very rich level, and even today is not particularly cheap. Consequently, I don't feel the administration is in any rush to try and arrest the decline. Read that again. The administration sees no urgency. The dollar is falling, and the people who could stop it, they don't want to. If this continues, the cost of living quietly rises, even if your income doesn't. When incentives align like this, outcomes stop being opinions and become math. And this is where the system starts cracking. Keep this in mind. It connects to everything that comes next. Now, the second data point. This one isn't a number. It's a situation. And this situation changes everything. The Federal Reserve is holding a rate decision meeting today. Rates are expected to stay steady. But here's the dangerous part. This meeting is happening while a criminal investigation is underway targeting Fed Chair Jerome Powell. An evolving effort is in motion to fire Fed Governor Lisa Cook. A successor to Powell is being nominated in May. Pause for a second. Let that satisfactorily sink in. The chairman of the world's most powerful central bank, under criminal investigation by his own government. Jan von Gerich put it simply. The most interesting thing about the Fed tonight is that Powell could now say something more on this political pressure because he's refrained from all of that so far. Think about what that means. Markets are waiting to see if Powell will finally acknowledge the pressure. And here's what most people don't understand. Central bank independence isn't just a nice idea. It's the foundation of currency credibility. Think of it like this. The Fed is supposed to be the referee in a game where trillions of dollars are on the line. When investors trust that the referee makes calls based on rules, not politics, they trust the game. When that trust cracks, capital moves, and it's already moving. The dollar's 4-year low isn't happening in spite of Fed uncertainty. It's happening because of it. Now the pattern becomes impossible to ignore. This isn't a coincidence. It's a system signal. But the third data point is where concern becomes certainty. Now the third data point, and this is the one that makes the outcome inevitable. 3 numbers that tell one story. Gold, record high above 5,380 an ounce. Brent crude, 4-month high above $68 a barrel. Euro broke 1.20 for the first time since 2021. Australian dollar, 3-year high above 70 cents. Now here's the trick. All of these assets have one thing in common. They're priced in dollars. When the dollar falls, everything denominated in dollars becomes cheaper for foreign buyers. Gold gets more attractive. Oil gets more affordable. Other currencies gain relative strength. This is mechanical. This is arithmetic. And here's where the math turns into fate. When gold hits a record high on the same day the dollar hits a 4-year low, that's not coincidence. That's repricing. The market is telling you something. It's saying we trust the rock more than the paper. Pause for a second. This is where it gets personal. If you hold savings in dollars with a bank account, a money market fund, cash under the mattress, those dollars now buy less gold, less oil, less of everything priced globally. Your wealth is being diluted in real time, even if your bank balance looks the same. And this is where the system starts cracking. European central bank policymakers are flagging growing concerns. The euro's quick appreciation is worrying them. They're warning it could drag inflation down below their 2% target. Think about that. The ECB is worried the euro is getting too strong because the dollar is getting too weak. This creates a feedback loop. Dollar weakness forces other central banks to respond. Their responses create more instability. More instability drives more capital into safe havens. Gold rises. Dollar falls further. The loop accelerates. When trust in money cracks, everything priced in it must reset. Why these three forces together make the outcome inevitable. Now let's connect the dots, because this isn't random. This is a pattern. You have the dollar at a 4-year low and an administration showing no urgency to defend it. You have the Federal Reserve under political siege, its independence questioned at exactly the wrong moment. You have every dollar-denominated asset repricing, gold, oil, and rival currencies all moving against the greenback simultaneously. 3 different pressure points, 3 different sources, one direction. When incentives align like this, the outcome stops being a guess and becomes a mathematical inevitability. Now let's invert. What would have to happen for this to reverse? The administration would have to signal it wants a stronger dollar. The Fed investigation would have to disappear. Powell would have to project total independence and confidence. Geopolitical tensions would have to ease globally. Does that sound likely to you? I didn't think so. The math makes this outcome unavoidable. So where does this end? The dollar found its footing today, up 0.37% to 96.27. But sentiment remains fragile. Markets are bracing for possible coordinated currency intervention by U.S. and Japanese authorities. The Fed decision comes tonight, with Powell potentially addressing political pressure for the first time. And gold sits at record highs while the world watches. Here's the sentence that tells you everything. Guy Miller at Zurich Insurance said it directly. I don't feel the administration is in any rush to try and arrest the decline. That's not speculation, that's strategy. A weaker dollar makes American exports cheaper. It makes American debt easier to manage. It shifts the pain to trading partners holding dollar reserves. And who pays the real price? You do, through higher import costs, through eroded savings, through a cost of living that rises even when your income doesn't. This isn't noise. This isn't politics. This is a monetary shift. This is confidence in America quietly breaking, slowly, methodically, but unmistakably. The ECB is worried. Asian central banks are watching. Gold is screaming the answer. And by the time most people realize what's happening, the repricing will already be irreversible. So what do you do with this information? 3 things: cold, logical, no emotion. First, understand your dollar exposure. If your wealth is 100% denominated in dollars, savings, investments, income, you're making a concentrated bet that this trend reverses. That's not a plan. That's a gamble. Second, watch the Fed tonight. If Powell acknowledges political pressure, expect more dollar weakness. If he projects confidence and independence, expect a temporary bounce. Either way, the structural issues don't disappear. Third, recognize what gold is telling you. When the oldest store of value hits record highs while the world's reserve currency hits multi-year lows, that's not noise. That's the market pricing in a new reality. None of this is advice. All of this is arithmetic. I've spent my whole career trying to understand incentives, and right now the incentives are screaming. The administration wants a weaker dollar. The Fed is under siege. Capital is rotating into hard assets. When trust in money cracks, everything priced in it must reset. This isn't about morality. It's about simple arithmetic. Subscribe if you want to think like capital, not like the crowd. I'll keep following the numbers so you don't have to guess.